Yes, indeed. We'll be talking about it a lot today, Scott. Nearly 15 years ago, the NASDAQ closed at an all-time high of 5,048, a time when tech stocks soared. And what we now know was the dot-com bubble. But with the NASDAQ now nearing its all-time high once again, there's a reason to believe that we've gone back into bubble territory. Joining us now is Venky Ganesan, Managing Director with Menlo Ventures. And Venky, 15 years ago, I guess you were still running, what, Trigo Technologies, a company you co-founded, eventually sold to IBM. So it's a different time then. You've made a lot of investments since. How is it different this time?
Well, I think what's different today is we have three trends happening. So if you go back to 1999, you had the internet. Well, today you have three trends: the mobile revolution, the cloud revolution, and the social revolution. And these three things have not happened at the same time before, and that's what creates a once-in-a-lifetime opportunity to create companies.
So how do you define a bubble? How will we know if we are in bubble territory? Is it if our expectations for what happens next are just completely out of whack? Is it just one or two little areas getting wildly out of whack, as some might argue biotech might be?
Well, the first rule I have is it's not a bubble if everybody's talking about it. So if you don't have people on CNBC talking about whether it's a bubble, then you should be worried, because that tells you that maybe now people think this time it's different. The second thing is that we still haven't, like in any innovation, in any cycle, we have what you call the innovators, the imitators, and the idiots, right? And when the idiots start showing up, that's when the bubble's going to end.
How do you define those idiots, Venky? Who are they, and what characteristics do they have? How do you know when they walk into a room?
Right, it's really hard, and you know, I wish I had a crystal ball to predict exactly when these things happen, but my rule of thumbs are people coming in to invest huge amounts of money with as little information as possible? And so there's a lot of discussion today because there's some late-stage private rounds that are happening, but the vast amount of financings in Silicon Valley today are not those late-stage investments. When you have the predominance of those investments happening from late-stage guys, that's when you have to worry about exactly who's coming in.
It might not be the majority, Venky, but some of the figures are still fairly eye-popping when you look at what Uber has raised. Granted, that company does have a lot of revenues, but when you look at what Pinterest and Snapchat, and those are just the ones that have been in the news in the last week. You know, we had a guest on earlier this hour that says the bubble might actually be in venture capital. There's just too much money, and they're trying to find a place to put it. Do you disagree?
I disagree. So the benefits of being at Menlo Ventures is we've been in the business of 40 years, so my partners have seen multiple up cycles and down cycles. What I'll tell you right now, if you just look at the stats in 2014, the number of venture capital funds are shrinking. The total amount of capital raised in 2014 is only 30 billion. Just to put that in context, venture capital raised 80 billion in 1999 and 120 billion in 2000. So just from the stats standpoint, I don't see it. Now, I know there are examples people out there say about a Pinterest and Uber, but those are isolated companies who are very special companies. The vast majority of companies are not being valued like that.
So when Gurley writes as he does in the FT, or he warns about overvaluation, I mean, is he trying to ensure that there will be more bargains for him to buy? Why does he say that?
No, Bill is right. There is no doubt about it that there are pockets of irrational exuberance in the venture capital space. No doubt about it, right? But the question is really, is that the preponderance, or is that an isolation? In any cycle, there are always periods where the market is kind of, a little parts of the market are inflated, and I think that's what Bill is referring to. The other most important thing Bill is referring to, which I think is true, is that private rounds are being done today with less diligence than public markets. So a company can raise 300 million in the private market with less work than raising 50 million in the public market. That's not a good trade-off.
So, Venky, what are we missing? Is it enterprise investment that's important right now? Is it investment in emerging markets that have different infrastructure needs than we've seen in developed markets? Where are you putting your investment dollars?
Yeah, so clearly cybersecurity is a big area of focus for us. We've had a long history of investing in it. I was fortunate enough to have been involved with Palo Alto Networks. We think cybersecurity is a trend that's going to happen over a long period of time. Mobile marketplaces, companies like Uber and Rover.com, which we have invested in, those are creating. And so that's the story nobody's talking about, is how mobile marketplaces are creating jobs and actually changing productivity. Think about the jobs Uber and Rover have created.
Yeah, well, we'll talk about it here then. No bubble sighted from there in Mountain View. Venky, thanks.
Thanks.